Okay, so now looking at 6.2, we are going to use a different method for accounting our uncollectible accounts, and this is called the allowance method. And this is better than the direct write-off because this will help us to record this in the actual period that it happens, which meets our matching expenses with revenue principle, which follows our GAAP guidelines. All right, so to do this, we have another new account called allowance for uncollectible accounts. Okay, and this is actually a contra account to accounts receivable. Okay, and it will look like this. All right, and it does show up in the asset section of the balance sheet because it does come in with accounts receivable in that balance sheet portion. Okay, so to do this, we have to estimate what we think our uncollectible accounts will be for a fiscal period. Okay, and there's two ways of estimating that. Two ways to estimate. One is percent of sales, and the other is percent of accounts receivable. Okay, so percent of sales means we just take net sales times a certain percentage, which is given, and a company will just sit down and they'll look at their records, they'll look at their past accounts, or maybe look at competitors to see what their percentage is, and they'll come up with a percentage that they think, a percentage of sales that they think will be uncollectible accounts receivable. Okay, so I want you to think of a big jar, and this jar is our allowance for accounts receivable. And basically, at the end of one year and the beginning of another year, we're going to fill this jar up all the way to the top. And then throughout the year, as we start deciding that some of our accounts are uncollectible, we're going to decrease our allowance. Okay, and then we kind of have an ending balance. All right, and then in the end of the year, then we'll fill it back up. Okay, but this isn't affecting our expense at this point. It's just affecting this little jar of allowance that we've set aside to account for this. Okay, so maybe that'll come back and make sense in a minute. These are adjusting entries. Okay, unlike the direct write-off. So this is happening on December 31st, and it's part of our long list of adjusting entries. And so basically, we're going to set up our allowance account. Uncollectible accounts expense. Okay, and the allowance for uncollectible accounts. Okay, and basically what we do is that at this point we go ahead and expense everything that we think we're going to use, and we assign that amount to this allowance account, which is kind of this jar over here on the side that we've got. Now to estimate this, one way is to do it percent of sales. So to do percent of sales, we take our net sales, and we are working on 6.2. So 6.2 says our net sales are $642,453.29. Okay, so 642,453.29. Now, net sales, where can I put this? Net sales, it's kind of a new term there, because this subtracts, well, is equal to sales minus any discounts minus any returns and allowances. Okay, then we have estimated, the company has estimated that 0.8%, so it's not a lot, right? It's a fraction of a percentage. 0.8% is our estimate of sales that will be uncollectible. So multiplying that, 5139.63. Okay, so for a whole year's worth of sales, we think $5,000 won't get collected from our customers, or approximately 5,000. Okay, so that's the number we'll use over here for our debit and our credit. 513963. Okay, so that's the adjusting entry for the percent of sales method right here. The other way to do it is percent of accounts receivable. And basically what they do is they break down into age groups the accounts receivable. So currently we have 32,000 in accounts receivable. There's 14,000 that's between 1 and 30 days old. 5,000 is between 31 and 60, and so on. Okay, and so for those different age groups, we have different percentages. So the older an account gets, the more likely it is that they're not going to pay us, and so you can see those percentages increasing. Okay, so then at the time we're trying to do this adjustment, we'll look at our actual accounts receivable and break it down to calculate the percent. So this is called aging accounts receivable. Okay, and this is a percentage of AR by due date, or really by past due date, right? Time past the due date. Okay, so we'll just start multiplying across, all the way across, to get what we think will be our estimate for uncollectible. So move my magic calculator, 964.64, 850, 74, 514, 86, 643, 02, and 921, 03. And then we'll add all those up. $3,894.29. Okay. Now, something that could happen up here as well as here. Don't think it just fits with this kind of aging accounts receivable. But if your problem ever gives you a current balance, we need to adjust for that current balance. Okay, and so that's where our jar comes back in. All right. So here's what we think our estimate is going to be. Maybe this is the 5,000 or the 3,000, whatever it is. And we use it, and we use it, and we use it, and we use it, and then we get to the end of the year, and we still have some left. Okay? and we have a new estimate for the next year. Okay, so we want to fill it back up, but we only want to fill it to this line. So we don't want to fill, I mean, there's this much that's still left. Okay, so we're going to have to subtract this much and only put this much back into our allowance account. Hopefully the visual helps a little bit. Okay, so it tells us that our current balance is $148.68 debit. Oh. Okay. So back to current balance. We got two situations here. And actually I just showed you this because we're going to come down this line and go back up. You could also end up going past this, right? And we pull out more than we think, and so we'll have to definitely fill it back up to the top again, okay? So you'll have to look at your directions and see if this current balance is a debit or a credit, okay? So remember, your uncollectible has a credit normal balance, all right? So if it says it has a debit normal balance, that means it went past what you had in there. So we're going to have to add that plus everything that goes back in. Okay, so you'll kind of have to look and see, is it say debit or a credit balance for the uncollectibles? Okay, so this one, our working together actually says a debit. Your on your own will say a credit. All right, so this one has a 148.68 debit. Okay, so that means it's got a negative balance basically at this point. All right, so instead of subtracting this, if it were a credit balance, we would subtract these two, but it's a debit balance, so we've got to add it and then add. Okay, so the answer here is 4042.97. Okay, so here's our estimate, but we're actually going to have to add more in because of that. All right, and then we'll come down here, and this is going to be our adjustment. So adjusting entries on December 31st. And again, this is kind of getting for things ready for the next year. And your allowance for uncollectible accounts. All right, so 404297. 4297. Okay. And this is page 18. Page 13. All right. So then again, like I said, if this said it was a credit, we would have subtracted those two. Okay. All right, so the next thing it talks about is that we wrote it off. Oh yeah, so now we're going to write off Marcia Ayers past due accounts as uncollectibles for $621. All right, so we're back to our general journal. We're back in action. It is January 6th, and Marcia Ayers, we decided to write her off. Okay, so this is we're writing off Marcia Ayers. So instead of the expense account like we used in the direct write-off, we're going to use the allowance. Because remember, we got this jar now, so we're using this account because it's our allowance. Okay, and then we're gonna have to decrease our accounts receivable from Marcia Ayers. This is memo 225 for $621.23. 1 and 23. Oh, it did tell us that that was page 1. Okay. Okay, so we are decreasing our allowance and decreasing our accounts receivable, and this is Marcia Ayers with our credits. Okay, then on March 29th, no, excuse me, April 14th, Marcia decides to pay us. And of course, we're going to take it. We're not going to tell her we wrote her off. We're going to take it. So we have to reverse this. And this is memo 259. Oops, let's put that there. I'll put this one here because we're going to post those twice. Same amount, $621.23. Remember, this is just reversing what we just did here. Okay, but we're also collecting the cash. So flip it over to your cash receipts. And on April 14th, we're taking Marcia's cash. And we will reduce her accounts payable. And this is page 4. Okay. All right, so sorry for all the breakup on the videos. I'll get them sequenced correctly. I just had a lot of disruptions as I was trying to record this. All right, that's the end of 6-2.